Greetings, and thank you so much for taking the time today to join us for a topic that I'm extremely passionate about, which is how to save taxes and thrive in retirement. My name is Nick Deffenthaler. I'm a partner, senior financial planner at Center for Financial Planning, and I'm extraordinarily excited to chat with each and every one of you who have taken time out of your busy lives about a topic that our team is very passionate about. It's how to save taxes in retirement, and not just in your retirement, but over the course of your future generation's lifetime as well, potentially. So it's an area that we spend a great deal of time on when serving our clients who have put their trust and faith in us to guide them throughout their financial journey in retirement. Before we dive in, because I know there will more than likely be a fair amount of existing center clients who are taking a listen today to learn even more about this important topic, but we're also going to have quite a few guests who are tuning in. So a little bit about the Center for Financial Planning. We're a privately held wealth management firm coming up on our 40th birthday, I like to say, next year in 2025. Our firm was founded in 1985. So we've been doing this for quite a long time now. The firm has certainly evolved quite a bit over the years, but one thing that has always stayed consistent, I should say, is our mission, which is striving to improve lives through financial planning done right. So what does that mean exactly? I get that question often. We think financial planning means a heck of a lot more than just managing your investments. That's certainly extraordinarily important. And as you can see on the bottom right of this really neat infographic that we've put together, we manage a lot of money for the clients that we serve, about 1.6 billion in assets. That's a lot of money, and a lot of folks have trusted us to manage their wealth over the course of nearly 4 decades. However, investing your money is just a part of what our team does. We want to take a look at things like taxes, which of course we're going to talk a lot about today. We want to understand your insurance. Do you have a well-rounded estate plan? Is the money going to flow to future generations the way that you want to upon your passing? What about charitable endeavors or philanthropic goals? We want to have conversations around that. And most importantly, we want to understand the goals that our clients have in retirement. That's extraordinarily important. We need to know what this money means to you, the goals that you want to achieve in retirement. That way we can create a well-rounded financial plan that we can work from each and every year. Because financial planning is certainly not a one and done sort of thing. It's an evolving process that we take clients through each and every year to make sure that you're ultimately achieving those financial goals that you have set forth. A little bit about myself, as I mentioned, my name is Nick Deffenthaler. I'm a partner, senior financial planner with the firm. Joined the center in 2013, became a partner and an owner in 2020. I typically do a lot of speaking like this that we're doing today, of course, oftentimes at local libraries or for the firm itself. I have a passion around speaking and educating folks just so we can serve as a resource, because frankly, there's a lot of not so great advice out there. And so our goal today is to simply educate. That's our mission. Whether you become a client or not, we want to make sure that if you're taking the time to tune in today, that you walk away with some great information. A little bit about me personally. I am married, my beautiful wife, Robin, my 3 kids. We live in Brighton. Our firm, as you may have seen on the slide before, we have offices in Southfield and Brighton. Actually work with clients pretty much all across the country, folks even internationally. So a little bit about me, because I think that's important to know who you're going to be hearing from over the next 45 minutes or so. But today's agenda, what you came here for today, we're going to be talking a lot about taxes. So I know tax season isn't always the most favorite time of year for folks, but we like to think about taxes throughout the entire year. It's incredibly important. As I mentioned, our goal, and I'll say this numerous times today during the webinar, our goal is to not only reduce taxes now for you and your family, but in the future. And not everyone takes that approach. And many CPAs or accountants, it's not a knock, but their goal is to get that tax liability as low as possible in a given year, and that's great. However, we want to be focused on the next 5, 10, 20, even 30 years. We know a lot can change, and that's why we want to be planning for clients throughout the year to make sure that we create a well-rounded retirement income strategy for folks that makes sense both now and in the future. So we're going to talk about things like our current historically low tax environment that may or may not be around for all that much longer. Talk about some of the most common, what I like to call tax torpedoes, how to defend against those, how we can potentially reduce tax now. Like I said, mitigate the effect that those tax torpedoes can have on your plan. And I know this is a recording of today's presentation, so we're not going to have live questions, but I'll entertain you with a few of the most common questions that I get from folks when I do this presentation live. So as we dive in, income, that's going to be a hot topic today, right? And how that income is taxed. But it depends on what kind, because there's so many different kinds of income, as we can see right here. Let's start at modified adjusted gross income. That's adjusted gross income plus tax-exempt bonds in most cases. Interest from tax-exempt bonds, I should say, excuse me. However, there's about 5 or 10 different types of MAGI, depending on what it's ultimately calculating. So that's issue number one. Then we have adjusted gross income. That's basically all of your income put together. It's used to determine how much you can put into certain retirement accounts, how much you pay on your Medicare premiums, that and MAGI as well. So those two calculations. So that's an important line item, certainly on your tax return. Taxable income. This is what goes to determine your tax bracket that you're in. It's essentially your AGI, or adjusted gross income, less any deductions. Okay. Provisional income, which we'll talk more about here in a few minutes. That's a complicated formula to determine how much of your Social Security is going to be taxable. Ordinary income. This is probably one of the most common types of income sources that we have. This would categories such as earned income that you have just from going to work, Social Security, pension income, retirement distributions from a 401k or an IRA are all considered ordinary income sources. Then last but not least, we have capital gain income, or dividends and interest. These are normally getting kicked off from your after-tax investment or brokerage accounts, as some might call it. Not referring to a 401k or an IRA, but these have their own different types of taxes, and depending on what your bracket is, you actually may or may not pay any tax on capital gains. So I'd venture to say there's a couple of you who might be listening right now who look like this gentleman on the far right, where his head's spinning a little bit. I'll be honest, I do this each and every day for folks. And my head sometimes feels that way because there's a lot of moving parts when it comes to this. However, you need to, in our opinion, you need to be partnering with a financial advisor who is taking these things into consideration, okay? So I always share with folks who might come to us for a second opinion and say, and ask that question. When's the last time your advisor has asked about your tax return? Are you doing any sort of proactive tax planning with your advisor and your CPA? And sometimes the answer is yes, and that's wonderful. But I'll say most of the time the answer is no. And I challenge that person to ask why. Why are those conversations not being had? Because at the end of the day, this is a critical component of your long-term financial plan, and it's an area that you can save a boatload of money on potentially over time, and it can certainly add a lot of value to your plan, okay? So let's talk about our current tax environment. Taxes went a lot lower in 2018. So the Tax Cuts and Jobs Act was put into law, presented to Congress by President Trump in late 2017, signed into law, became effective in 2018, okay? These tax rates, unless made permanent by Congress, are going to expire at the very end of next year. So our old tax rates that were higher in 2017 are coming back into play in 2026. So I put this chart together. On the far left, you see the old rate, which would be 2017 and before. The new rate is actually the current rate, okay? So where we stand right now. And as you can see, there's some differences there. At the end of the day, tax rates for pretty much everyone ended up going down. There was also some significant changes when it came to standard deductions and being able to itemize and the elimination of personal exemptions. All of those things are set to sunset, like I said, at the end of 2025, going into 2026. So next year in 2025, after our election, is going to be a very hot topic year on taxes. So for a numbers and tax geek like myself, that makes us excited, probably puts a lot of other people to sleep. But there's going to be a lot to talk about and more than likely a lot to plan for. So my thought and our firm's thought has been for the last 6-7 years, how can we be effectively planning now to take advantage of this historically low tax environment? Because when taxes are low and we have certainty around where these tax rates are, in many cases, it makes a lot of sense to accelerate income and have income flow through to your tax return, even if you might not necessarily need it. We'll talk more about that here in a few minutes. But at the end of the day, this is a big thing that's coming up for a lot of folks. Also affects the estate plan, or excuse me, the estate tax exemption amount. So like I said, 2025 going to be a busy year. So let's get down to business. Let's start talking about the various tax torpedoes that I mentioned in the very beginning. The very first is going to be related to required minimum distributions, or RMDs. RMD, we have a lot of acronyms in our world, so this is the first of several that I'm going to cite today, so fair warning on that end. A required minimum distribution essentially is saying the government at some point wants you to start taking money out of those retirement accounts that you've been saving diligently into for many, many years, okay? These only apply to traditional / pre-tax 401ks, IRAs, SEP IRAs, simple IRAs, etc. They do not apply to Roth IRAs or Roth 401ks. Up until about a year ago, they actually did apply to Roth 401ks, but not Roth IRAs. IRS loves to make this stuff kind of complicated. So things have changed. Now Roth IRAs and Roth 401ks, no RMDs whatsoever, which is a huge value add of those sort of accounts, which certainly we'll talk more about here soon when it comes to Roth IRAs, because they're a wonderful planning tool that we use often for clients. Common question I also get, how much is it? How much am I going to have to take out of my accounts? In zooming out a tad, and I should have mentioned this in the beginning, how old do you have to be? When do these begin? So things have changed quite a bit over the years. About 4 years ago, you had to take them at 70 and a half. Then the IRS changed that to 72. Now it's 73. And for those who have birthdays or birth years, I should say, in 1960 or later, your RMD age is now 75. Okay, so that's continued to get pushed out due to life expectancy. It certainly doesn't mean that you can't take money out of your IRA or your 401k before that, but at some point you're forced to do that. And it doesn't mean that you need to spend that money. IRS says you just got to take it out. That way we can tax you on it. Because at the end of the day, when you put money into that retirement account, you didn't pay any tax on that money, and it's grown quite a bit over the years. So at some point, government, if many of you have not heard, we have quite a large debt issue at the moment, so we could use some tax revenue. So that's going towards that, obviously. So how much is that initial RMD? For your first year, it's going to be right around 3.6%, okay? And that percentage of the balance is going to go up each and every year you get a little bit older. So use a very common or simple example. If you have $1 million IRA, that first year RMD that you're going to need to take is right around $36,000. Okay. If you end up forgetting it, IRS has gotten a little bit more lenient on this. It used to actually be a 50% penalty on what you did not take out. It was massive. They've now changed it to 25, which is still a very hefty penalty. However, if you're able to fix it in a relatively quick fashion, IRS seems to be becoming, like I said, very lenient on that. And as long as we're obviously withholding tax and going about it the right way, then you typically can avoid that penalty. However, I'm telling you right now, you don't want to go there because it's going to be a lot of time and effort on your end to provide proof that you ended up doing it, et cetera. Our team has processes in place where that just doesn't happen for folks at the end of the day. So if you do have these sort of accounts and your advisor has not talked to you about your RMDs quite yet, or if you're doing this on your own, this is the first time you've ever heard of them, reach out if you have questions or talk to someone, because it's very important. We don't want to mess this stuff up. A lot of money at stake if we do. If you don't need that money, I'll say, I get this question often. Can I gift the money to a child, and do I still pay tax? Yes. because your child technically is not a 501c3 charitable organization. Some might argue that their kids are like that, but at the end of the day, the only way, unfortunately, to avoid the tax on this is by gifting that entire RMD amount or a portion of it to charity, which we'll talk about more here soon. Okay. However, for folks who don't want to give everything to charity, which 99% of the folks that I encounter, and even those who want to gift, they usually want to gift a portion, maybe not the entire amount. There are some folks who do. However, what do we do with that money if we don't really need it? If you're in that position, which many of our clients are, because they have strong fixed income sources, Social Security, pension, annuity income, whatever it may be, they might not need that full amount. You can gift some to charity. You can all end up taking that money, having it taxed, go into an after-tax brokerage account, reinvest it. I'm seeing more and more, folks who are gifting some of that RMD money now to kids or grandkids to help them fund a 529 education plan or a Roth IRA to help kickstart retirement. Because retirement's going to be a challenge, certainly for a lot of folks who are still in that accumulation mode, might be fighting student debt. Cost of living has certainly gone up quite a bit. The death of the pension. I mean, you'd be hard pressed to find anyone in their 40s or early 50s who have access to a pension. So point being, those are some options there. RMDs can create some issues though, because at some point in your 70s, that money is hitting that tax return. We can't really do a lot about it at that time. However, there's some planning strategies, which we'll get into soon, that will discuss how we can reduce those future RMDs if we plan properly. Inherited account IRA, or inherited account RMDs. A lot has changed with those. We now have to take money out of an inherited IRA, money that you received from someone who passed away within a 10-year time frame. However, I won't go into all the details. There's a lot of nuances when it comes to this new rule that went into effect in 2020. But basically, if you inherited one of these accounts from someone who passed away in 2020 or later, this new 10-year rule applies. Okay. It does not apply, however, to folks who are married. So if husband passes away, wife rolls the husband's IRA into her own IRA, she is not subject to that 10-year rule. She can take money out over her own lifetime. All right. Things changed quite a bit, like I said, in 2020, because prior to the Secure Act, which changed the game with these inherited IRAs, if someone died and you inherited that money, as an example, my mom's single, if she leaves her IRA to me because she loves me so much, realistically, it's just because I'm an only child. She leaves that money to me. I could stretch those distributions out. I would have an RMD each and every year because that was always required from an inherited account, but I could take out maybe 4 or 5% of the overall account balance for my entire lifetime. It was depleted. So not as much income was hitting my tax return each and every year. Now I have to take that money out within a 10-year time frame. So if you think about that, if someone has $1 million IRA that they're inheriting, it's a wonderful problem to have, right? But at the end of the day, if you're just keeping it simple and say, we need to take out $100,000 a year out of this account, not even accounting for growth, that 100 grand to make sure you deplete that account within 10 years, even if you're just taking it out, having it taxed and moving that over to an after-tax brokerage account that you can reinvest, you got to pay tax on that money. And think about it. For those folks who are inheriting those accounts, they might be in the prime earning years, right? So they're already earning a nice income. Then you have 100K in addition hitting that tax return. So I work with some folks who have inherited these accounts, and they need quality tax planning more than ever because of those sort of nuances. So ways that you might be that you could potentially prevent, or I should say mitigate this effect, is by shifting more money out of an IRA during your lifetime to help prevent some of these issues. Doesn't make sense for everybody, but at the end of the day, we always like to think ahead. What can we be doing now, given our current tax environment and legislative environment, to make sure that more money stays in your pocket, your family's pocket, instead of the IRS, okay? Moving on to tax torpedo number 2, that would be Social Security. Social Security is, as I mentioned earlier, is taxes or as an ordinary income source, okay? It's fairly tax preferential. And I know a lot of folks debate, and a lot of folks are not happy that they have to pay tax on it because this was a form of tax that they paid into Social Security. But let's not go there today. Let's just talk about, how this works, how it functions, and how we might be able to make the most of it. Okay. So treat it as an ordinary income source. It is not taxable in the state of Michigan, which is a good thing because about 11 states out there do tax Social Security. Okay. With Social Security, there's a common misconception I see all the time because of this provisional income calculation that's rather complex. Most people will end up paying tax on Social Security, or I should say, the amount of Social Security that will be included in their income is a better way to say that, will be somewhere between 50 and 85% of their total Social Security benefit. Okay. It's not a 50 or an 85% tax. And that's a common misconception when I go over this because this is a tricky formula at the end of the day. So the way that this calculation works to determine how much of your Social Security is included in your income is we take your adjusted gross income. Okay, so things like pension, if you have any employment income, which a lot of cases it doesn't make sense to draw Social Security while you're still working, or 401k or IRA distributions, those things certainly go into your adjusted gross income or your AGI, right? Then we might have some tax exempt interest from municipal bonds, things of that nature. And then we take half of whatever your Social Security benefit is, and we add those things up and we come up with your provisional income. Okay, so let's say that your AGI was 60,000. Okay, pension, IRA distributions, etc. Okay, and then we have let's pretend this client doesn't have any municipal bond interest, so to keep it simple, right? So 60 grand, and then they have 30,000 of Social Security benefits. However, we cut that in half at 15,000 plus a 60, we land at 75. That's the client's provisional income. That provisional income amount is used to determine how much of that $30,000 a year Social Security benefit is included in one's tax return. Okay. And I bring that up because the more that we affect AGI, the more taxable your Social Security benefit, or the more includable, I should say. I don't know if includable is an actual word, but we'll go with it today, is more includable in your overall income. So this is something to keep an eye out for. I see it all the time where folks think that they should be doing a Roth IRA conversion, as an example. However, if we do that Roth conversion, that increases your AGI because we're shifting money out of an IRA to a Roth. That's a taxable event. So for someone who might not be paying much tax or anything on Social Security, if they do a large Roth IRA conversion, that's going to dramatically increase the provisional income and in turn start taxing that Social Security benefit a lot more. Okay. Doesn't mean that you never do them, obviously. There could be a balance to be struck, but it's certainly something to take into consideration that I think is missed all too often. And so at the end of the day, it's certainly something that we want to take a look at. Now, for folks where, maybe their provisional income is already at a level where because it's, the thresholds aren't all that significant, as you can see on the slide. If 85% of their Social Security benefit is already being included in their overall income, that makes the calculation a lot easier because we're not going to increase it beyond that. It is what it is. They're already there. So if we do Roth conversions or realize capital gains, by selling a security in a client's after-tax portfolio, that's going to increase their AGI. But at the end of the day, if the client's already at the 85%, can't really push them any higher than that. So definitely something we take a close look at when trying to put together this retirement income puzzle, as I like to say. All right, tax torpedo number 3, capital gains. First and foremost, I always like to start here. This form of tax, if you will, does not apply to 401ks, IRAs, Roth IRAs, retirement accounts like those. Okay. Those are tax deferred vehicles. When someone's talking about dividends, interest, capital gains, and how you have to pay tax on those, almost all the time they're talking about an after-tax brokerage account. Okay. So at some point, if you received a bonus at work and you received $50,000 net of tax, right? So 50,000, you say, you know what? I don't really need that 50,000. Good problem to have. I'm going to invest that money. So you open up an investment account, you put 50,000 in there. That money's already been taxed, right? Now, over the course of time, hopefully that 50,000, if you invest it well, is going to grow. It's going to pay dividends, interest, things of that nature, right? And so at some point, you might sell some of the stocks for profit, but at the end of the day, your 50,000 is something known as your cost basis. You're never going to pay tax on that again because you already paid tax on it. You're only paying tax on the dividends, interest, and any profit that you might make on that, okay? So let's look at it as an example. After-tax brokerage account, you decide to buy $10,000 worth of stock when the pandemic hit in 2020. Ford stock, now we're 22,000, excuse me, got a little tongue-tied there. So we now have a $12,000 capital gain. Depending on what the rest of your income looks like, that will determine how much tax you pay on that capital gain, okay? A lot of times folks hear a $12,000 capital gain, they think it's $12,000 of tax. No, not how it works. Most folks out there are being taxed at either 0%, believe it or not, or 15%. However, as you can see on the chart below, the higher your ordinary income sources are, so once again, employment income, Social Security, pension, IRA distributions, etc., the more tax you pay in Social Security, or excuse me, with capital gains, okay? So if you are in the 12% bracket, which means that a married couple, you could have about 120,000 or so, 125,000 of gross income before deductions and still be in the 12% tax bracket. If that's the case and you have some capital gains, you pay a whole lot of nothing on that profit, which is great. Not a lot of folks are aware of that. So in many cases, if folks have some wiggle room and they're married in that 12% bracket, we can go up to that total income level and ultimately sell some of those positions that they may see some profit in and not pay a dime in federal tax. Now, there could be some state tax considerations. Can't discount that, but we're just looking at federal for now, okay? Now, where this gets tricky is kind of similar to Social Security. The more other income sources that you have, like I said, either through pensions or let's say you do a big Roth conversion in a year, and now you push yourself into the 22% bracket. You were well within the 12% bracket, but you do an $80,000 Roth conversion because you heard that Roth IRAs were the best things ever and everyone should always have one. Spoiler alert, that's not the case. They don't make sense for everyone, even though they are incredibly powerful. But now you're well within the 22% bracket. And you find out the hard way that, hey, I sold some Ford stock and now I got to pay some tax on it. Well, if you didn't do that conversion, or maybe you reduced the conversion amount, you still could have been in the 12% bracket and we would have realized income at that low amount and you wouldn't have paid any capital gains tax because at the 12% bracket, you pay zero. So a lot of moving parts there. Once again, with this, it's a very complicated web and there's always a push and a pull. And then once again, capital gains, these things, even though they might be taxed differently, they still flow through to your adjusted gross income. And once again, your adjusted gross income ultimately helps determine your Medicare premiums at some point. So if you realize a very, very large capital gain, that could blow things up on a Medicare standpoint, which great segue. Speaking of which, that's going to be our tax torpedo number 4. Medicare, or something called IRMAA, another acronym. I warned you, there's a lot of these in our world. IRMAA stands for Income Related Monthly Adjustment Amount, okay? And basically what this means is if your income is at a certain level, you're going to pay more for Medicare, okay? Part B and D premiums. At the end of the day, it's just another tax. It doesn't affect that many folks, about 5% of Americans, but a lot of the clients that we have the pleasure of serving do run into this issue because they've saved really well for retirement over the years. They had a good income. And so their income level is typically above the average. So I'd say about 20% or more of our clients ultimately face this issue, and how do we navigate it? Or they might in the future, and we're doing planning for them to help mitigate that issue, okay? Medicare does what's known as a 2-year look back on income. So when you turn 63, is actually the year that Medicare starts looking at your income to help determine what your premiums are going to be on your first year of Medicare at 65. Okay. And at the end of the day, this is a true cliff. So as an example, if you're a married couple and you had income in 2022 of $206,001, you are paying more for Medicare premiums, your Part B and D. It's a cliff. It's not the same when it comes to our tax code, where we have this blended tax code where if you find yourself in the 22% bracket, some of your income is taxed at 10, 12, and 22. So if you just go into the 22% bracket, it doesn't mean that now all of your income is taxed at 22. It's just that overage. Not the case when it comes to Medicare. You go off by $1, you're paying more. Okay. Now you can file an appeal. So if you had a life-changing event, which means job loss or death of a spouse, marriage, divorce, things like that, you can file an appeal. So in 2022, if you were still working, as an example, and you were earning $250,000 a year as a married couple, you're now retired at 65, and Medicare is looking at your income saying, well, it's 250, back in 2022. So you're actually going to pay, that 244.60 a month in monthly premiums instead of the base amount for you and your spouse, which is going to mean at least a couple grand more in Medicare premiums for the year. You can file an appeal and say, look, our income is this now. I was working at the time. That's not a good representation of where we are today. However, if you did a really big Roth IRA conversion, or you sold Tesla stock and you generated a $250,000 capital gain, spoiler alert, they don't consider that a life-changing event. That's something you had full control over. You can't go back to them and appeal it and say, well, I don't plan on doing this again, so can you give me a pass? They're going to put a big denied stamp on that appeal. So you got to be careful when it comes to this stuff. Sometimes there's nothing we could do about it. It is what it is, but we have to plan around it. But there are some strategies that we can do and take a look at if we plan prudently ahead of time to keep these Medicare premiums as low as possible. Okay. The final tax torpedo that we'll talk about today is the widow's penalty. I will tell you, this is probably one of the most, the areas that people are not talking about as much as they should, in my humble opinion. Does not get nearly as much attention as it should. It has major ramifications if we don't plan properly. At the end of the day, for the married couples who might be joining us today on the webinar, at some point, unfortunately, someone's going to file a single when they do their taxes. Someone's going to pass away at some point. We hope it's a very long time from now, but we have to plan. We can't put the blinders on and pretend that will never happen. Okay. As you can see on the far left, taxes are a lot different for single filers compared to those who are married. Okay. As an example, for someone who is married, they can have taxable income, so gross income of about 125. So after deductions, we land on about that 94,000. You could have about 125,000 gross, 94,000 net of tax or taxable income, and still be in the 12% bracket if you're married. That number is cut in half if you're filing as a single individual. Okay. In almost all cases, when someone passes away as a married couple, the only income source that's going away is the lower Social Security benefit between the two. If there's a pension involved, sometimes there might be a reduction in the pension because there hopefully would be a survivor benefit or survivor option. But at the end of the day, income generally stays about the same, with the exception of that lower Social Security benefit going away. So as an example, let's look at a traditional, example where, husband passes away, had a Social Security benefit of 40,000. Wife took the spousal benefit at 20,000. Okay. Which can be obviously 50% of husbands, maybe she's a stay-at-home mom, that sort of thing over the course of the years. Use a simple example. All right. Husband passes away. Wife's $20,000 a year Social Security benefit drops off. She then steps up to the husband's $40,000 a year Social Security benefit. So there's a loss of $20,000 of income, okay? That's coming off the tax return, right? That's the only thing. So let's take a look at that client. Let's pretend they're 80, okay? And wife's in good health. Very feasible that she lives another 10, 15 years, maybe even longer, right? So 20,000 is now not hitting the tax return. However, let's pretend they have some decent size IRAs and a decent size joint investment account, and assume that maybe they had about $45,000 of RMDs that was hitting the accounts. Those RMDs don't go anywhere. Those are going to continue to hit the tax return because, as I mentioned earlier, wife can then take her husband's IRA, roll it into her own. But at the end of the day, the calculation's the calculation, assuming they're about the same age. So that RMD amount, that's still hitting the tax return, okay? And then maybe they had, like I mentioned, that joint investment account. So there might be things like capital gains, dividends, and interest. Nothing changes in that regard when someone passes away. So I've done some calculations, and for a married couple who might be at the very top end of the 22% tax bracket who loses a spouse in that example, they could end up landing in the, now that single filer would be in the 12% bracket. But it's not as simple as a 10% different in tax, okay? Because a lot more of that client's income when they're filing single is getting taxed at 22%, as opposed to in the other example, okay? And also that single filer, very good chance now, if we go back one slide, same thing with Medicare premiums as we talked about, okay? Similar to tax rates, those get cut in half when it comes to determining how much income you need to qualify for higher premiums. So if we assume that in that example at a very high level, that single filer now has an increase in federal tax and Medicare premiums, and we look at that Medicare premium increase essentially as an additional tax, that single filer, that wife could see a 56% increase in tax. That blew my mind when I did the math. It is a major issue, like I said, that not a lot of folks are talking about. And I hear it often when I bring up the topic of Roth IRA conversions, where we say, you know what, let's try to shift money now early on from an IRA to a Roth while your tax rate is low, because those make sense in those situations. And by doing so, that's going to, in theory, reduce your future RMD. Because if we're taking money out of an IRA, we're shifting it to a Roth. Those Roth IRAs do not have RMDs because that's how the government is setting them up. And even if they did, they wouldn't be taxable. This is a tax-free account. However, you know, if we're chipping away at that, we never do any Roth IRA conversions. If a client has $1 million IRA at 62 and they never really touch it all that much for their income needs, and we assume about a 7% rate of return, that IRA is going to double in size in 10 years, which means at 72, 73 years old, when they have to start taking the money out for RMDs, their RMD is now, you know, $75,000, $80,000. And maybe they were waiting until 70 to take Social Security. So now you have all this income hitting your tax return at once that's putting you into a higher bracket, higher Medicare tier, et cetera. And then it just gets exacerbated even more when a spouse passes away. So I might hear sometimes for clients and say, Nick, I get the strategy, but you know what? We're always going to be in this general income range. I said, yes, until someone passes away. And then things dramatically change. So I spend a little bit of extra time there because, and I hate to sound like a broken record, I've said it a few times, but no one's really talking about this as much as they should, in my opinion. So have that conversation with your advisor, talk to them and see what are some ways that we can help mitigate that. So how do we avoid some of these torpedoes, or at least mitigate some of the torpedo effect, as I like to say? A couple that we use frequently with clients are all on here, to be honest with you. How are we efficient with giving money to charity? How can we be as tax efficient as possible when building out an effective asset allocation for someone? If someone has an IRA, a Roth IRA, and an after-tax investment account, which is the case for about 80% of our clients, each and every one of those accounts has a very different tax attribute, let's say. Roth IRAs grow tax-free, IRAs grow tax-deferred, after-tax brokerage accounts, not so much. So we have to be very intentional with the types of investments that we're housing in those, right? And even when it comes to risk, right? So Roth IRAs, generally, we want to make those a little bit more aggressive, because if there's ever an account that we want a little bit more growth in, guess what? It's going to be the one that we don't pay a dime in tax. So we might make the other accounts a little bit more conservative. So that way, when we put everything together, it's still an appropriate allocation for a client. Helping folks determine what sort of retirement accounts to contribute to, something we spend a lot of time on. Collaborating with the client's CPA, providing tax projections, making sure that we're working together as a team for the client. When that happens, typically folks get better results. Withdrawal strategies, which we'll talk more about here soon. Which accounts do we pull from at what time? How do we put this retirement income puzzle together? And something you've heard me talk about quite a bit already, Roth IRA conversions, which, because that's one of my favorite topics, let's talk about that next. So now we talked about the torpedoes. Now we're talking about how to defend those to some extent. We've already I couldn't help myself, scratched the surface on a few of those strategies already, but we'll dive into them here a little bit more in the next 10 or 15 minutes before we wrap up. So at the end of the day, Roth IRA conversions, we're picking money out of a pre-tax IRA, dropping it into a Roth. When that happens, it is a taxable event. That income is flowing through to your income tax return, right? When do we do these? When does it make sense? Most of the time, it makes sense to take a close look at these when you expect to be in a higher tax bracket in the future, okay? And we can make that guess or that assumption usually in two different ways. There might be more income hitting your tax return later on in life because of those RMDs, or maybe you decided to wait till 70 for Social Security. So we know at some point, your income is going to be a lot higher that's hitting the tax return that we don't have a lot of control over. So let's take good advantage of the situation now, what I like to call the gap years, very common, from 60 to 70, let's say. I'll show you an example here in a second of that. What can we be doing now to be proactive to plan for that? Or we could say, we think just because of where we are in the world and as a country, at some point, we're going to need to increase taxes. And it might just not be for the ultra wealthy. It could filter down to other folks. And we saw that. Even if rates go back to where they were in 2017, even tax rates for those in the 12% bracket, you would end up going up to the 15% bracket, which is where we were in 2017. So those are some of the things that we like to take a look at. What bracket are you in now compared to what tax bracket are you going to be at in the future? That's typically one of the most important things that we need to look at. So if we say if a client, we have this conversation, we say, you know what, we do think taxes are going up. And we also know that, clients waiting until later 60s or 70 to turn on Social Security, at that point, income sources are going to increase. So, hey, we're kind of in the middle of the 22% bracket right now. Let's fill that bucket up. Let's get you all the way to the top end of that 22% bracket, because we know when RMDs start or when Social Security starts, we're going to be in the 24% bracket or maybe even the 32, if tax law changes. So, and by doing that and by moving money out of the traditional IRA into the Roth, that means we're shifting money and reducing the value of that IRA. It's all about trying to reduce, to a large extent, those future RMDs that you might have, okay? So a good example here, I know there's kind of a lot going on, so I'll walk through it. What you're seeing right here is the incredible impact that partial Roth IRA conversions can have. And as I mentioned, this is a great example of someone who did these for the course, over the course of 10 years, right? So in the yellow line, you're seeing how much someone did, they did some Roth IRA conversions, they shifted, in year one at age 60, they only had a traditional IRA represented in the gray bar. They started doing some partial Roth IRA conversions before Social Security and RMDs began. And so they wanted to accelerate income while their income level was relatively low, okay? It's a great way to go about doing it. So that yellow line shows the Roth conversions. And then when Social Security started to kick in, they stopped taking it, Okay. And this is a software program we're able to use with folks all the time to, try to quantify the value and see if it even makes sense for you. Okay. Stop doing the Roth IRA conversions, later 60s, early 70s. And as you can see, the orange bar shows the value of that Roth IRA, which goes up significantly over time. Now, it might seem kind of crazy to see how much that has gone up, but you know what? Time is your best ally when it comes to investing. And where we are right now in the Dow as an example, it's just, if someone would have cited where we're at now and back in 2005, you'd say, oh my gosh, are you crazy? There's no way we're going to get there. We do over time in most cases. So these numbers are very realistic, not guaranteed certainly, but at the end of the day, it's certainly within the realm of possibilities. And so in the black, you see at some point, someone has to start taking money out of their IRA through RMDs. And that goes up over time, right? Because the older you get, the more money you got to take out. But guess what? If that client did not do those partial Roth IRA conversions for the course of those 10 years, this black line would be way up here. It would be massive. Because if you're not chipping away at that IRA balance, once again, maybe a good problem to have, but there's a good chance that you're going to get crushed on taxes later on and pay a significant amount more for Medicare premium. So a lot of things that we've already talked about, convert income or do Roth conversions when income is low. It is a balancing act. Sometimes I have heard other practitioners or clients have come to me and said, I heard I should convert everything to a Roth IRA. Everyone should have a Roth. I mean, when you hear those general, statements like that, I typically say run the other way or put the earplugs in because it's typically not good advice. In our experience, doing these Roth IRA conversions gradually over time is typically in a client's best interest, makes the most sense. Because if not, we do too much, we're just blowing up their taxes and we're not filling up lower brackets that we could have along the way. Okay. And they don't make sense for everyone. I mean, if you're already in a very high bracket right now and you expect your kids to also be in a high bracket, it probably doesn't make sense to do these. But at the end of the day, your advisor should be looking at that and not just in the current year, but over the next 10, 15, even 30 years into the next generation to see what could be a prudent plan for you when it comes to these. The next item that we take a close look at for clients is gifting effectively. To charity, I should say. So I mentioned earlier, but in 2017, tax law changed quite a bit. The standard deduction amount more than doubled in size, which now means, and I could spend 20 minutes talking about this, but for the sake of time, bottom line, when it comes to charitable planning, very few people are now seeing any economic benefit from gifting to charity because that standard deduction amount has gone up so much. So what are some ways that we can be very intentional? One of the most common ways that we think is very powerful is something called the Qualified Charitable Distribution, or the QCD. Basically, what that means is if you're over the age of 70 and a half, because RMD ages have gone up, but this QCD age of 70 and a half actually has not changed. If you're at least 70 and a half years old, you can start gifting money directly from your IRA to charity. This strategy is especially powerful, in my opinion, when you do have to take RMDs and you do not need the full RMD amount. I touched on this a little bit in the very beginning. So let's say, as an example, your RMD for the year is $15,000, but you normally give 10 grand a year to your church. You don't really need all 15 because you have other great income sources. You have other ways that you can pull, for money, and you don't want that income hitting your tax return, because if you do, it's going to put you in a higher bracket and it's going to put you in a higher Medicare tier. So we can gift $10,000 directly from your IRA to charity. So that way you're facilitating that gift. And now $5,000 you still got to take out, but that 10 grand, you essentially have a reduction in your adjusted gross income. So in a way, it's a roundabout tax deduction, because more than likely, if you're a married couple, it's tough to get over, standard deduction amount for a couple over 65 is almost $33,000 now. So you got to have some big time deductions between mortgage interest, state and local income tax, charitable deductions to exceed that. Okay. So this is a great way to go about doing it because it reduces your adjusted gross income it's not a tax deduction, but it's still a way to facilitate these in a very tax efficient manner. Couple logistical nuances with these that are incredibly important. Cannot do these from a 401k or a 403b, SEP IRA, or simple IRA. Don't ask me why, because a traditional IRA has the same exact tax treatment, assuming it's all pre-tax money. But the IRS says, nope, can't do it from those, has to come from an IRA. So we've worked with clients over the years who might have a 401k or a 403b. We roll the money to an IRA. It then qualifies them for them to be able to do the QCD strategy. Also, you have to gift money directly from the IRA to the charity. That's critical. If you take that $10,000 in my previous example, you take that distribution, you have that money hit your bank account, then you write a check from your bank account to your charity, you blew up the strategy, you can't use it. It was a waste. Money has to go directly from the IRA to charity. Another great way to facilitate gifts, specifically out of after-tax investment accounts, so not related to the IRAs or 401ks, is gifting appreciated stock, bonds, mutual funds, etc. Okay, so you can actually gift, let's say, 20. Let's use this example. I have one here. Might as well use it, right? So let's take a look at on the far left in the green. If you have stocks in an investment account, you paid, let's say it was Microsoft stock. You bought it for 20,000. It's now grown to 50. Okay. You sell that stock, there's a $30,000 profit or capital gain. So you got to pay some capital gains tax on it. And in this example, the client has some pretty hefty income, so their capital gain rate is relatively high. So they pay about $7,000, just over that in cap gains. So they have about $43,000 left over. That's what they give to charity. That results in about close to a $16,000 true tax savings. Okay. However, person on the right has a really good financial advisor and tells them, you know what, don't sell that stock, gift that stock directly to the charity or to a donor advised fund to facilitate that gift. When that happens, you don't have to sell it. You gift all 50,000 of that Microsoft to the charity, at which point, once the charity gets it, they can sell it. And as a 501c3 organization, they don't pay a dime in tax when they do. So that deduction, that there's more money going directly to the charity and directly where you can write that off on your taxes. That results in almost $18,500 tax savings. It's almost a $3,000 difference to you. So it's a wonderful strategy. There are some nuances. There's some limits on how much, percentage of your adjusted gross income you can gift securities. So make sure you consult with a professional when it comes to this. But the bottom line is this. In the tax landscape that we're living in now, if gifting to charity is important to you, it's critically important, in our opinion, to make sure that you're looking at these strategies and make sure you're doing it the right way to save you money, have more money in your pocket compared to Uncle Sam. As we wrap up, let's talk about some spending strategies. This is what we spend a great deal of time on with clients every single year, not just in one year, because your life is going to change, tax laws are going to change, etc. Right? So how do we get a client, money? How do we fill that proverbial gap in what they want to spend? So some of the things that we don't have a lot of control over when that income hits: pension, Social Security, if you have annuity income, or RMDs. Now, as we talked about earlier, we can potentially affect and reduce the impact of those RMDs. But at the end of the day, unless you're converting everything to a Roth, you're going to have that income hit your tax return. Now, other liquid accounts where you have some more flexibility would be things like after-tax brokerage accounts. How much money do we take out of TDA accounts, tax-deferred accounts like IRAs, 401ks, etc., or Roth IRAs? Conventional wisdom, most advisors out there would say, you know what? We want to take everything out of these taxable brokerage accounts first, because you know what? The bulk of that money's already been taxed. And we're going to keep your taxes really, really low and not even touch those IRAs, those Roth IRAs that get you the money that you want to live on. Not always the best approach, typically the wrong approach, in our opinion. When you always have this one-size-fits-all mentality, it's typically the wrong one. And that's when I tell folks just to plug their ears, like I mentioned earlier. A balanced approach among these different accounts is typically the best way to do it. And a lot of this hinges on Once again, what bracket are you in now? Which bracket are you going to be in the future? Tax rate's going to increase. Just a myriad of factors that we talked about today. So very important to, not be caught up into only one way of doing things for folks, because at the end of the day, this adds a lot of value to your plan. And you're going to be retired for a long time. And if you're able to save considerable amount of money on taxes over your lifetime, it can certainly go a long way towards supporting your goals that you have when you are no longer working. So quick case study before we wrap here. Married couple, just to kind of highlight how we might approach things when it comes to determining putting this retirement income puzzle together for a client. So we have a married couple, age 65. They want to spend about $120,000 a year in retirement. Like many of our clients, they've accumulated about $1 million within their investment portfolio. In between Social Security, pension, they got about $78,000 of fixed income sources. Those things are hitting the tax return no matter what. So where do we get the rest? How do we fill that gap with the $42,000? It's got to come from the portfolio. We've worked with these clients. We've determined that about a 65% stock, 35% bond allocation would be appropriate for them, given their goals, their investment horizon, how much money they need to, draw from the portfolio, et cetera. So how does that end up shaking out? All right. I always like to have about $20,000 left over in cash or money markets, short-term CDs, treasuries, et cetera, because that ends up being about 6 months worth of cash needs of that $3,500 a month, or $3,500 a month that they need to take. Okay. And reason being is because when we hit rough patches in the market, not if, but when, we in a perfect world don't want to be selling stock funds that are down maybe 20 or 25%. So we do a lot of work behind the scenes of not only, how do we distribute that money, but how do we invest that money and continually refill this cash bucket in the most tax efficient manner. And so if we take a look at that $1 million total portfolio, as I mentioned earlier, about 70-80% of our clients have a mix just like this. Money in an IRA, money in a joint investment account, money in a Roth IRA. Okay. So for these folks, $500,000 in the IRA, $350 in the joint investment account, $150 in the Roth IRA. So how do we get them this $3,500 a month? What's the approach we should take? As I mentioned earlier, in many cases, advisors would say, take all $3,500 a month or 42 grand a year from this joint investment account. You're probably not going to have to owe a dime in tax when you do that for the year. Okay, that sounds all well and good, but do the math. If you take that approach, you're going to deplete that account within about a 7 or 8 year time frame, more than likely, right? Then what do we have left? This IRA and the Roth IRA. Yes, hopefully they've grown over time, but now we've kind of backed ourselves into a corner a little bit, because now this $500,000 has a lien on it in the form of tax liability, right? So a blended approach, in our opinion, is typically a much more prudent way of going about doing things, especially in this low tax environment that we're living in. So this is how I would slice it. I would take out about $3,000 a month from the IRA, the remaining $500 from the brokerage account or from the joint investment account, and a whole lot of nothing out of the IRA. Okay. And I'll explain the why here in a few minutes. So how do we get there? How does this math shake out? And I know there's a lot here, but I'll walk through it that way everyone's on the same page. So as I mentioned earlier, $78,000 between taxable Social Security and pension, $12,000 of capital gains, dividends, and interest, specifically coming from this joint investment account to get these clients $500 a month or $6,000 a year. Then, of course, we have the $36,000 coming out of the IRA. That gets us to about $126,000. Okay. Now let's pretend these clients take the standard deduction. They're over 65, so they get a little extra kicker. So that puts them at about just under $94,000 of taxable income. That's virtually right up to the very top end of the 12% bracket. So there was some science behind that, right? Because we could have taken out even more out of the IRA, but it would have pushed them into the 22% bracket, which isn't ideal. Okay, we want to take advantage of this low rate that they're in, right? Another value add of keeping the clients in that 12% bracket is the component here of capital gains they don't pay a dime in tax on the federal side. Because if we remember, if a client remains in that 12% bracket, they pay 0 on capital gains tax, okay? We leave the Roth IRA as is because we want to keep as much money in that account as we can over time. Now, it doesn't mean we never touch it or, there's chains and padlocks on it. In some cases, it does. But in years where we don't really need that money, we can lean on other sources. Let's let that thing grow. It has wonderful tax attributes. Give it time, because time is a Roth IRA's best friend in most cases. And there could be a circumstance later on in life where a client has a very large unexpected expense. And so we do want to tap into that Roth IRA to a certain extent, because when we take money out of the Roth, it's not taxable, okay? So that additional income that's not hitting the tax return that we could take from the Roth could prevent them from getting thrust into a much higher bracket or paying more in Medicare. I got ahead of myself a little bit, but kind of the why behind some of these things, and I'm just going to bring all the different points down. At the end of the day, what I always like to say, heads you win, tails you break even. And I think that's, in this situation, it tells the story perfectly, because sometimes clients will say, well, Nick, we're always going to be in this bracket. It's always going to be in this range. Well, I say, well, what if taxes go up? Do we think they're going much lower than this? Probably not. So heads you win, tails break even. You didn't harm yourself. Now, I have seen folks, I think, kind of harm themselves when they go a little crazy with these Roth conversions or taking too much money out of the IRAs early on. But in this approach, I think it's a good mix for these folks. I like the tax diversification, as we talked about, different buckets that we can pull from. And most importantly, I would say, if we're chipping away, once again, this client's 65. They don't need to take money out of the IRAs until they're almost 75 years old. If we don't touch those IRAs for spending needs or to convert money to a Roth, that IRA is going to continue to balloon. And that's going to mean a higher RMD that's hitting their tax return later on, which, once again, certainly if tax rates go up, that's going to be an issue for them. Allows us to control their Medicare premiums a little bit more effectively, et cetera. So this work that we do for clients, I just outlined, is something we do for folks every single year. It's part of our services, and it's massive, because if we're not taking this approach and we're not taking taxes into consideration, it's a huge miss and it could be costing you a lot of money. So make sure you talk through that with your advisor. In closing, I mentioned, I want to throw out a couple different, typical questions that I'll get from folks, maybe in a live event. One of the most common ones that I get, which I think is a wonderful question, is, Nick, I need to take my RMD soon. I don't really need the money. Can I just convert that money, and does that count towards my RMD? Okay, convert that money to a Roth. So if you have an RMD of $50,000, can I just take $50,000, convert it to a Roth, and now I've checked the box, I've satisfied that RMD? Unfortunately, no. I wish you could, but you actually have to take the $50,000 out first, and then conversions can occur after that. Okay, so that's a popular one. Another popular one, I would say, is in regards to the folks that we typically serve, or how do we go about helping clients? Most of the clients that we work with, we're in the Metro Detroit area, okay? Doesn't mean that we don't work with folks all across the country, but we have the pleasure of serving some of the most kind, down-to-earth, just wonderful people that I could ever imagine. So blessed in that regard. These folks have saved very well for retirement. In most cases, they didn't receive this massive inheritance. It was just a product, them accumulating the wealth that they have is just a product of good old-fashioned saving, hard work, and discipline, which I just have a tremendous amount of respect for. These folks normally find extreme value in a professional relationship. They prefer to delegate the financial matters in their lives. However, when I say delegate, it doesn't mean not be involved at all. They want to be actively involved in this process, but they realize they don't want to do this every day and that they're not an expert in it like we are. Because of that, because of the depths of service and advice that we're providing for clients, in most cases, we're serving folks who have accumulated at least $500,000 of assets. However, we certainly help clients who are well above that. And maybe it makes sense to have conversations if you're not quite there yet. So at the end of the day, as I mentioned earlier, we're here to help. The goal is to be a resource and help you any way that we can. And, at any point, we're happy to get on a 30 to 45-minute call with you, talk about your situation. In many cases, it does make sense to continue the conversation of potentially working together. Other cases, it doesn't, and that's fine. But we'll make darn sure that by the time you get off that call, in-person meeting or Zoom meeting, you feel great about your situation. You walk away equipped with more information than you had before, and you know where to go with it, okay? So I end with this slide. You've come this far. Don't let the trip of a lifetime turn into a nightmare. I bring this up because I think there's a lot of parallels with climbing Mount Everest and retirement planning. So this quote by a gentleman by the name of Eric Arnold, who tragically actually passed away on one of his final attempts of climbing Mount Everest. Eric said, 2/3 of the accidents happen on the way down. If you get euphoric and think I have reached my goal, the most dangerous part is still ahead of you. I just think they're so perfect as well when it comes to retirement planning. Many of the folks that we have the pleasure of serving come to us in the couple of years leading up to retirement, and they say, you know what, Nick and our Center for Financial Planning team, we've done a great job doing this on our own, and we've come this far. But at this stage in our lives, we have too much to lose. We don't want to step on any unintended landmines. And even if they did a good job doing it on their own, they don't want to be bothered with it in retirement. So they connect with a professional in their team that they can trust, who they know is going to take good care of them and look at a heck of a lot more than just their investments. And that's what we're here for. So if you do have questions and you would like to have a conversation, reach out, feel free. Check out our website. We have countless wonderful resources that you can take a peek at. I do want to thank everyone for taking the time to join today. Hopefully you found a lot of value in it. Feel free to reach out soon and have a wonderful day.